Hi, I'm Sameer Jain at ActiveAllocator. We've met with over 100 broker-dealer systems and presented to probably 5,000 financial advisors over the last 5 years. And what I've come to discover is the holy grail is the market need for an integrated asset allocation and portfolio construction system that straddles liquids and illiquids, traditional and alternatives, active and passive investing. This industry is ripe for digital disruption. And it means going beyond robo, beyond traditional. It means marrying digital advice with human value add. So we see a need for a fact-based approach to decision making, not gut feel and precedent. And this is especially even more so within the alternative investments piece of wealth management. Now, alternative investments are a fast-growing category. However, they've always been very difficult to include in affluent investors' portfolios, and we discovered firsthand that these make up just 4 to 7% in typical retail client portfolios. And this is in part because most folks lack some means to quantify and demonstrate their accretive portfolio benefits. And that's not surprising. I mean, given mind-boggling heterogeneity across almost 40 subtypes within real estate, private equity, hedge funds, liquid alternatives, managed futures, oil and gas, credit structures, and fixed income substitutes. These investments are poorly understood. And the widely used assumptions in modern portfolio theory are often violated, as these can be less liquid, they're widely disparate in their characteristics, and many have poor or inconsistent recorded historical performance data. So traditional methods of optimizing a portfolio to fit investors' goals and risk tolerance, which has proven useful in determining percentages of stocks, bonds, cash, in typical portfolios, cannot handle the very different attributes of illiquid and actively managed assets. So ActiveAllocator is built to account for these special issues. Things like stale pricing, which creates serial correlation in returns, which understates volatility, reporting bias from instant history, survivorship, selection bias, which overstates index returns. Volatility itself is not a proxy for risk, as historical returns exhibit negative kurtosis, skewness, as well as downside risk. So illiquidity demands a premium, but it is hard to calculate it as it varies. Managers themselves exhibit style drift once you give them money, which is hard to catch given asymmetric information. And then there are difficulties in differentiating between expensive active skills versus cheap passive market exposure. So our portfolio construction module, which is in an advanced stage of development, overcomes challenges that investors face when allocating to active managers. And these include comparing managers, accounting for limited performance histories, separating true prized skills from cheap market exposure and luck. We also address asymmetric information and opacity in the returns generation process, and we manage the effects of changing market conditions when containing downside risk. I'd like to believe that our approach is an active one, for we proactively forecast the degree of uncertainty in future returns, in volatility, in correlations of fund managers. We also provide the ability to include soft qualitative views from a firm's due diligence function, and we incorporate a degree of confidence within a quantitative manager allocation framework. Our approach allocates simultaneously across multi-dimensional return sources, including alpha, skills, beta, market exposure, accessible inexpensively, downside risk, extreme but rare market movements, and of course, illiquidity whose term premiums can be purposively unlocked. The general idea is now an entire range of investments can be included in portfolios. So it is a way for investors to consider all of their investable assets in a unified framework and make informed, intelligent decisions about how much of each is appropriate for your objectives. Also, our framework can be used to demonstrate when non-traditional or alternative investments can improve the performance of portfolios. It helps investors to make intelligent decisions about balancing liquidity needs and the potential for higher returns. It provides portfolio-minded investors an expanded range of investments to choose from. So I'm going to encourage you to take a test drive at ActiveAllocator or just get in touch with me if this is of interest. Thanks for listening in.